Hi there, my name is Derek Van Ness and I'm with Big Life Financial. And today I want to talk to you about the smartest or a smarter way to pay your house off early. And I say this because a lot of people want to pay their house off early. They want to get rid of that debt and they want to make sure that their family's safe and they don't have to worry about that, especially when it comes time for retirement, right? So what we want to talk about today is contrasting the traditional idea of paying extra toward your mortgage toward a better, smarter, and I would say, and safer way to pay your house off, okay? Here's what I mean. And if you're not familiar with this, I'm gonna just start from the very beginning. But the idea is that when you have a loan balance and you're paying a mortgage, let's say it's a $400,000 house, and you're making payments toward that house, over time, as you make payments, the amount that's owed on the house goes down like this, right? Now, the idea is if you make extra payments, so on a $400,000 house, I think the payment without taxes and insurance, because those vary from state to state, is about $1,967 at 4.25%, okay? So if you were to pay extra toward that house, the idea is that this balance declines faster and you pay the house off faster, which is absolutely true. The problem is, as you're paying all that extra money in, so let's say you're paying an extra $1,500 a month into this to pay off your mortgage. The problem with that is, as you pay that extra $1,500 a month, that money is now going into equity, right? And equity, the problem with equity is, and you can ask anybody from 2008, is when you have money in equity, you can't necessarily get to it unless the bank wants to give you a loan. And if I know anything about banks, it's when you have money, right? When you have lots of money, the bank will give you more money. When you don't have money, guess what? The bank won't give you money. So what happened to a lot of people is they have this idea, I'm gonna pay $1,500 a month extra. So they start paying down like this. And then 2008 comes along right here, bang. And it smashes their income. They lose their job, they get laid off. If they were in real estate or lending or any of those areas, their income went away. They went back to the bank and they said, hey, we've been paying you this extra money every month. How about if we get a loan so that we can get through this tough time? And the bank said, well, you don't have an income and you have a lot of equity, so we're just gonna foreclose on your house and we're gonna take it. And the problem is a lot of people lost their house plus all that extra money that they've been paying into their house. So what if there was a smarter way to do this to where you could stay liquid, you could pay your house off just as fast and build something for the future? Is that something that you'd want to know about? So I want to show you real quick, if I go over here, a way you can figure out how to prepay your mortgage. I don't love everything that Dave Ramsey teaches, especially about building wealth, but I do think he has some really great tools and he's good at helping people get out of debt. So you can go here and you can look at the mortgage payoff calculator, right? So let's say we put in a $400,000 mortgage, and let's say the first date of that is 12/1/2019, which was just last month. You start off with a 30-year mortgage, and you're going to pay, you have a 4.25% interest rate, right? Now, it looks like your payment is going to be $1,967, like I said, but if you want to pay extra to it, we can click here and we can look at how much extra do we want to pay. Now you can see here, if we just paid our normal payment, this is our pay down process, and we're done at 2049, right? 30 years from now, just like it's supposed to be. And the total amount paid, $700,000, which is what usually infuriates people. And for good reason, there's better uses of your money, right? So if we were gonna pay an extra $1,500 per month, starting on the 19th, I'm sorry, on the 1st of the month, I gotta make sure I get this right. Yep. We would calculate the results. And you can see here, by paying $1,500 into your mortgage every month, You pay it off by May 2032, which is 58% faster. And that's pretty awesome, right? You can see this curve goes down a lot faster. And this is what a lot of people are doing. And you see all kinds of videos on the internet. However, like I said, the problem with this is all the time that you're paying this extra $1,500 a month, it's not going into your savings. It's not going into some type of retirement vehicle or another place you can get to it. So you're left without that cash if some hard times ever come along, or if some opportunities come along. Because I deal with a lot of real estate investors, and that extra $1,500 a month could buy a lot of rental properties over the course of 10 or 15 years too. So we can even click here and we can see the pay down schedule, right? As we're paying into it, we can see our balance going down, how much is going to interest in each payment, how much is going to principal. And if you don't know anything about this, you can see that in the very beginning, most of your money's going toward interest and a little bit's going toward principal on your 30-year or on your pay down schedule, right? So if we come down here, and the other way we would have been done by, or if we do the pay down, we're done by 2032, right? You can see that that gets all the way down to 0 here. So, and you can see along the way you're paying this extra $1,500. So you get down there by 2032. So let's back this up and let's look at a comparison that I'd like to show you. So first payment, 12/01/2019, right? And it's 30 years at 4.25%. Okay, so now we can look at the full payment schedule. So this is the schedule without any of the extra money, without the $1,500 going in. And we can see along the way the whole, 30 years of that process, right? Now, we know that according to the other one, by May 2032, we would have paid it off. If we weren't paying extra, we still owe $291,000 by May 2032, right? Or, $294 at the beginning of the year. So this is where our payoff would have been. Now I want to show you that there's another place that you could build up the cash instead of building it up here in equity. Let's say you did something that did this. So you've got your loan that gets paid down like this to 2049. What if you could build cash instead of paying extra to the bank? What if you could build up your own cash to meet that? And at this point, you would have enough cash to pay it off. But the nice thing about this is all this money that's in here is yours along the way. So if a 2008 comes along, you've got all this cash. If you lose your job, if the economy changes, you go through a divorce, an illness, family member pass away, whatever, you've got cash to be able to deal with that until you decide to pay it off here. And if we could do that in a similar amount of time, this would certainly be a lot safer, because now our money's not locked up in equity. It's in a place where we can do it. The question is there a place and is there a way that we can build up cash fast enough to pay this off close to or the same as May of 2032, right? So I've run some numbers here, and I'm a wealth strategist and I teach people concepts like this all the time, but we use a specially designed tool that's a type of life insurance policy. Now, if you've heard a lot about life insurance, I want you to put some of what you know about that on the shelf for just a minute, and I want to show you real numbers. So if someone was 40 years old, they were putting $1,500 a month in this, instead of putting it into the equity of their house, you would see that the cash value would build up. Now, the first knock that a lot of people have on life insurance is that it doesn't build cash very fast. You can see that when you put $18,000 into this policy, immediately the way that it's been constructed, most agents, in my opinion, don't optimize policies this way. Almost $14,000, $13,692 is available in cash that you could use at any time, just like you would out of a bank account. It takes a couple more days to get it out. Like, you can't go to the corner bank, you got to get it from the insurance company, and they got to mail you a check, but you can have your money within about a week. And you can see that that cash builds up. And if we look by year, let's see, so this pays off, May 2032 is about halfway through year 13, right? Because December of 2031 would have been 12 years. So 12 and a half years in, where are we at here? 12 and a half years in. 12 years in, we've got 269, which would be where we would be December. So we don't quite have enough here, but you can see that by the time we get to the end of the 13th year, which would be actually December here, December of 2032, we've definitely got way more than enough. And if you do the math back and forth, it ends up in almost the exact same place. So now you're in a position where between year 12 and year 13, at that same point in time, so if I go over to the other chart here, at essentially this same point in time, May-ish, could be May or June, of 2032, you actually have enough cash that you can now pay for this thing in its entirety if you want to. Now, the interesting thing is that cash is earning you a decent interest rate. Inside of the insurance companies we work with, you're going to earn 4% plus a dividend on that money. So then you've got to decide, do I want to pay off a 4.25% mortgage, or would I rather have my money continue to earn and grow upon itself at 4% plus the dividend? Just for the record, the current dividend is a little over 2%. So in total, you're earning about 6%. That number could change a little bit, although it's at a historically low rate right now because interest rates have been so low. You can make that decision. But the difference here is you pay the house off in the same amount of time, but you're protecting your family with insurance, and you're using all of that, or you're building up all that money in a place where you don't, if something happens along the way, you don't put your family at risk, right? If a 2008 comes along again, or 2001, or whatever the next financial crisis is, because it seems like there's one about every 10 years, that your family's going to be protected. You don't lose all your money like these people did up here in equity, and you're in control. And if an opportunity comes along, you want to invest in real estate, you want to start your own business, you want to do other things along the way, you've got access to all of this cash the entire time, right? And if I go back to the other page here, you can see that that cash builds pretty substantially, right? 6 or 7 years in, well, let's say 10 years in, it's over $210,000. You've only put $180,000 in, plus you've got over $1 million of life insurance available here, right? So I wanted to just illustrate to you that I believe that using a tool like this is a much smarter way to pay off your house early. It's almost the exact amount of time, but you're safe the whole time, and you don't have to pay it off if you don't want to. You've got opportunity along the way, you've got insurance for your family, and you're in a much better position, in my opinion. So if you'd like to know more about this, because the key to this is if you're going to use a tool like this type of life insurance policy, you need to be working with the right person, with the right insurance companies. My firm, Big Life Financial, we'd be happy to show you how this works and how it might apply to your situation. It also doesn't have to apply to something where you just got the mortgage. If you got this mortgage and you're halfway through it and you want to start paying extra, we can run the numbers, we can look at what that looks like, and we can help you determine what's best for you. So we'd love to help you with that. Hopefully this is valuable for you. If it is, go ahead and like and subscribe our page, tell other people about it, and please click the link below to go ahead and set up an appointment with one of our specialists. We can take you through this and show you how it works. Again, my name is Derek Van Ness, and we appreciate you taking some time to invest in your own future and taking care of your family.